If you're walking into an investor meeting hoping to impress them with your deal, you've already lost before you start. The operators who get funded aren't the ones with the flashiest pitch decks or the highest IRRs. They're the ones who control the psychology of the room. Look, for context, my team and I have done over $3 billion in deals. I've seen this play out over and over again. So today, I'm breaking down the exact preparation system that makes investors chase you instead of the other way around. Part one, most operators prepare for the wrong meeting. See, most operators think preparation means polishing their pitch deck, tweaking the IRR projections, or tightening up the spreadsheets. But that's not what gets the capital to move. See, most people walk in assuming investors already believe in them, and all they have to do is make them believe in the deal. That's completely backwards. See, investors don't care about your deal until they've bought into you first. See, as an operator, I get it. You live this project every day. The job sites, the numbers, the grind. But investors, they don't see any of that. They get one meeting, 30 minutes at most, to decide if you're credible. So don't lead with hype. Lead with proof. Proof of effort, proof of results, evidence that what you've done before, you'll be able to do again. So here's what that looks like in real life. Years ago, we worked with a client building a private debt fund for an equipment leasing business. Their customers wanted equipment now so they could run their business, not 6 weeks or 10 weeks from now when the bank finally approves the loan. So the customers would happily pay a higher rate of interest to get the equipment the same or the next day. And investors on the other side that were funding the equipment couldn't grasp this concept. Why would somebody pay 19.99 to 29.99 interest instead of 6 or 7% at the bank? So we told the story. Imagine a contractor who lands a mall cleaning job but needs a new machine tomorrow. The bank takes weeks. The lender funds instantly. So that extra $100 a month in interest payments would make perfect sense for that individual to be able to go and run their business. Now, once investors understood the use case, the numbers clicked. Now, that company went on to raise nearly $70 million in a really short period of time. Same goes for my first 8-figure real estate fund. Back in 2010, 2011, people couldn't understand why we were buying strip mall plazas in Arizona. See, that was the opportunity because when we were buying buildings that were 2/3 empty in 2010, 2011, after the 2008, 2009 crash, what was happening is two things. One, there was no financing. So everything you bought, you had to buy with cash. But number two was that 1/3 occupancy in that building was occupied by somebody that was going to get paid by Medicaid or Medicare. So we had, I think, pharmacies, prosthetic limb manufacturers, hearing clinics. They were tenants that regardless of what was going on in the economy, people still had insurance, they still had benefits, so they still needed those services. Our bet was that we were able to buy those buildings for pennies on the dollar, and when the market picked up and those other spaces were released, we would be able to add a lot of value. Obviously, as time went on, we were right. See, when you can translate your world into proof investors can see, you stop auditioning for their money and you start qualifying them for your opportunity. Because this train's leaving the station with or without you. Point number two, know who you're actually talking to. See, most operators pitch every investor the same way, and that's a big mistake. You literally have to tailor everything because high net worth individuals, family offices, and institutional investors, to name three major categories, live in three completely different worlds. And you should actually move through them in this order. And when you're raising capital, in my opinion, you should move through them in this particular order. Group number one is high net worth investors. Number two is family offices. And number three, eventually, if you get to that scale, is institutional investors. So look, for context, the reason why we talk about high net worth investors being the first place to start for your capital is because those investors are literally buying into you first. They have a tendency to invest earlier, potentially take on more risk, and they do expect higher returns, but ultimately they're betting on your judgment. And that's why so many 9 and even 10-figure operators that I know today still work primarily with high net worth capital. Doctors, dentists, entrepreneurs, business owners, they literally see themselves in you. Their capital is flexible and it's personal, and they don't want or need the same level of monthly excruciating reporting. They still need transparency and reporting, but ultimately they're investing in you first. The second group that you move up to potentially is family offices. Now, there's two types. There's single family offices that manage one person's fortune. So think about Elon Musk or Jeff Bezos or any multi-billionaire or someone worth multiple 9 figures. They typically have what's called a single family office. And then there's multi-family offices, which pool several families together. So for example, if you've made 25 or $100 million, you need those services, but you probably don't want to have millions of dollars in overhead when you're just managing $50 million. I know it sounds crazy to say it that way, but that's literally the way it works. Look, either way, family offices, they still value relationships, but they run on structure, mandates, committees, due diligence checklists. They can literally take months to get in the door and sometimes a year plus to close a deal. But the good news is once you're in, the capital from family offices is sticky and long-term. Also, family offices write bigger checks. $25 million plus is not unusual, but they also don't want to be the first money in a deal. So if you haven't built an investor base and you don't have a track record, all those accredited investors I talked about earlier that are high net worth people, if you don't don't already have a foundation of that in place, getting a family office to jump in on your deal is going to be a tough sell. Finally, you work your way through family offices and you're still growing, you still need more capital. There are the institutional investors. And look, they're not betting on you, they're betting on your machine. They literally first look at your systems, your governance, and your compliance. In my experience, they won't even take a meeting with you unless your resume and your operations look institutional grade. Audited financial statements, board of directors, governance. These are starting points for institutional investors before they write $100 million plus check. So let me give you a real contrast. A few years ago, we raised accredited investor dollars for a home services business. And in the early years, our initial investors were high net worth individuals. And what actually got them to invest wasn't just the spreadsheet, it was the story. They understood how the product fit into their lives, how people interacted with it on a day-to-day basis. And because of that, it felt more tangible. So they took more risk. They believed in the vision and they helped us prove out the model. Now, fast forward a couple of years, we had traction, returns, systems. We built a full business. And when we had that in place, I flew to New York to negotiate a $100 million commitment to actually recapitalize the business. Now, unfortunately, COVID hit mid-process and that deal never closed. Acts of God aside, the experience was invaluable. And the principle there still stands. That meeting was an entirely different world. The deck that we started with on the institutional side was 150 pages long, and 90% of it was in font so small I could barely read it. That conversation at that boardroom table wasn't about belief anymore. It was about verification. The investors were already sold on the sector, and they just wanted the proof that the structure could handle their scale. That's exactly why you have to match your message to your audience. Tell big vision stories to institutions, and you sound small. Bury your high net worth investors in spreadsheets, and you sound cold. Your preparation must fit their psychology, not your comfort zone. Point number 3, master the vehicle internal external framework. Once you know who's across the table, you have to know how to build belief in the right sequence. See, investors move through 3 subconscious questions: vehicle, internal, external. And if you miss the order, you lose the meeting. The first part is the vehicle. So do they believe in the space itself? If they don't buy into the vehicle, they won't buy into you, period. When we raised money for the home services fund, we started with the trend. People were ditching outdated, hardwired security systems, those old contracts that quietly printed money for decades. And people were moving into full smart home automation. And being able to control your home from your phone sounds obvious today, but back then it was revolutionary. The same idea applies everywhere. In multifamily, the trend is renters over buyers. There's a lot of people now that consciously want to be renters, even if they could afford to own, because they want flexibility. In assisted living, it's baby boomers retiring in droves. So there's a massive demand wave coming. So you've got to paint that line of inevitability. In other words, this thing is happening regardless of our involvement. And look, if you want proof of that, nobody's investing in Blockbuster anymore. They're looking for the next Netflix. Being tone deaf to that is the equivalent of trying to pitch the Blockbuster business model today when everybody's already on to Netflix. Just presenting a vehicle that isn't matched with what's going on in the world, it doesn't matter how fantastic you are, you're getting no traction. Part number 2 is the internal piece. So once they believe in the vehicle, they ask themselves, can people like me make money with people like you? That's literally your credibility layer. So you show proof, exits, track record, execution. It's not bragging, it's reassurance. In one pitch, I remember I skipped 20 slides and just walked through one previous deal. The same structure, same market, same outcome, and the tension just disappeared. They could see we'd done it before. Part number 3 is the external. So only now do the numbers actually matter. Deal terms, returns, minimums, the mechanics of participation. Most operators start here and wonder why nothing sticks. Until belief in the vehicle and you is solid, the external details are meaningless. Point number 4, control the frame from minute 1. Everything you've built so far, the story, the data, the structure, can collapse if you walk in with the wrong energy. Because if you're hoping for approval, you've already lost. Investors don't just read your numbers, they read you. That's exactly why I created the easy method, which is exclusivity, abundance, scarcity, and your allocation. So E for exclusivity is you're not one of 100 operators begging for money. You're one of the few people with access to opportunities worth serious attention. You can say something like, we're pretty selective about who we bring into our deals. It has to be the right fit both ways. That line instantly shifts the frame. A is for abundance. So you operate from a place of abundance. So you're not asking for help. You're extending an opportunity to participate in something that's already in motion. And the subtext here is simple. We're doing this anyway. The question is whether you want to see it. Having that abundance mentality makes your investors more comfortable anyways. And S is for scarcity in the allocation. So you can literally introduce it in the context of, look, we typically work with 8 to 10 investors per deal. And that's not a gimmick. It's a reality based on how much room we have, what the average investment size is. And scarcity changes the psychology from should I invest to how can I still get in? Y is the last piece, which is your allocation. So ultimately you're qualifying their intention. And you can ask it like, so if everything checks out on both sides, what amount would you be considering? And that question actually filters people out for the real people that want to write a check versus the people that just want to kick tires. If you're thinking that's too forward, let me be upfront with you. First of all, make sure you have your legal documents in a row before you ask investors for capital. But I can tell you in my heart of hearts, I know for a fact that most investors within the first meeting, first few minutes, they've already decided whether they're going to potentially invest. And if they do, how much. So in their mind, they're already thinking 50,000, 500,000 or 5 million bucks, whatever that is. So you might as well just find out if the juice is worth the squeeze, because intention matters. When you know who's serious, you know where to spend your time. And there's nothing wrong with going 9 rounds of due diligence and going back and forth in data rooms and legal and documents, but you really need to understand what the value of that conversation is. If you actually do get the yes, is it a $50,000 yes or a $5 million yes? So that's how you can control the frame: calm, confident, selective, and direct, because capital doesn't chase need, it looks for conviction. So that's how you prepare for an investor meeting that actually works. It's not by memorizing a script line by line, but mastering psychology. Understand who's across the table, build belief in the right order, and control the frame from the very first minute. So this has helped you. Make sure you share this video with other fund managers, capital allocators, or operators who actually do deals. And keep watching, because the next video breaks down what investors really look for inside your pitch deck and how to structure it so they lean in without checking out.